Jahangir Aziz is now with us, Head of Emerging Market Economics Research at JPMorgan. Jahangir, good morning. Good to have you back on the program. A lot has happened since the last time we spoke. I will ask you, of course, what your forecasts are for US, odds of a US recession, and etc. But first, a quick word on what the bond market is doing, because I think a lot of attention there. That bonds are not, US, it's not acting as risk-free. It's not acting as a safe haven, US government bonds. What's the problem, Jahangir?
Look, I mean, it's the manner in which these tariffs and the other policy changes that have been undertaken in the last, 3-4 weeks. I think we began the year and the view that, there would be extreme policy shifts under the Trump administration. That was given. However, regardless of how extreme these shifts would be, one thing that would be preserved is that the balance of these policies would be pro-growth, and the balance of these policies would be geared towards extending the expansion rather than truncating it. I think that's the question that the last 3-4 weeks of policy flip-flops, extreme tariffs, and alongside that, the other policies that are taking place in terms of, DOGE-related and immigration-related policy changes, I think that has crept in. And I think because that has crept in, you are seeing that being reflected both in a rise in the risk premium on US bonds, as well as the dollar actually doing the opposite of what it does in typical global risk-offs, which is that instead of appreciating, it is actually depreciating.
So is it a temporary thing, Jahangir? Or you think this safe haven status, dollar, US assets, dollar, etc. I mean, it's being questioned a little more permanently here.
No, I don't think that it's a permanent shift in US dollar being the safe haven. I mean, look, there are obviously undertones in the broad strategy of the administration that the safe haven or the reserve currency status of the dollar had artificially appreciated the dollar over the last 25, 30, 40 years. And that has been one of the reasons as to why US has a trade deficit. Now, whether you agree with that argument or not, there are, high-up members of the White House, people like Stephen Merrin, et cetera, who wrote a note back in November arguing this, making this argument. So clearly there's an undertone within the different things that the administration doing is that they want the dollar to be lower. And one of the reasons as to why the dollar is higher is because of its reserve currency status. I don't think that, this is a permanent shift, but I think the acts that they're doing or the actions that they're taking is questioning that, at least temporarily. And again, you do have this time two other, alternatives, euro and the yen. If you didn't have them, then I think you would still go back into dollar strength.
Oh, absolutely. And we've seen that. I mean, the move on the yen has appreciated big time, 143 this morning. Yep. And the euro, I mean, look at the euro, just march higher, 1.1 plus on the euro dollar as well. Jahangir, great to have you with us on the show today. So it seems, at least for now, the bond vigilantes have prevailed. They've managed to rein in Mr. Trump. Now, from gauging risk perspective, is the worst behind us, you think? Because he's climbed down, he's opened this 90-day window. And when he was asked whether he'll extend the window, he didn't outrightly deny that reporter question. He said, we'll see. So it's only the China issue which remains outstanding. Would you believe that the inflationary impact and the worst impact of these tariffs, at least with the rest of the world, that risk has blown over?
So think about what the average effective tariff rate is. Right. So before the pause, after April 2nd, the average effective tariff rate rose to 23% for the US. Right. Then, came the retaliatory tariffs on China, and then the pause. And after all of this, you now have an average effective tariff rate of 25%, and that I'm using based on the 125% tariff on China, not the 145. If you do that, it's probably close to about 27%. And this does not include the tariffs that are forthcoming, which is on auto, semiconductors, copper, and autos that are coming. Pharmaceuticals that are coming in the next couple of weeks. You add them two together, or add these three together, and you're now pushing it close to 30% of tariff with 145 on China. Regardless of which way you cut it, if you put in a tariff of this size, doesn't really matter whether the focus is on China or not on other people, you are going to get prices to go up. So I don't see how this alleviates any of the inflationary problems that China has, that US has.
So recession?
So after the pause, we are still sticking with that, second half of the US will go into recession. That was a baseline prior to the pause. That remains a baseline. For global recession, we still don't have it in a baseline, but we have a 60% probability. We haven't changed that probability. I think people are missing out an important part of all of this dynamics. It is easy to say that, look, the focus is only on China. It is on China. But if you have 125 or 145% tariff on China, and China has a 185% tariff on US, under those circumstances, US-China trade will virtually freeze. I mean, unless you critically need something, you are not going to participate in any transaction between US and China. And if that happens, and I know that, people mention that, well, the exposure to US and China is low, or US is low, or China is low, and therefore that country is safe. Most of the other trade that people do, let's say in India's case, most of the trade that India does outside of US and China is also related to the supply chain that goes through US and China. So if the trade between US and China comes to a halt, this is a actual shock to the global trading system. The two largest traders in the world are not trading with one another. And if you have a shock to the global trading system, no one gets spared.
All right, Jahangir, very quickly before we let you go, the dollar index has weakened, and normally we would say emerging markets do well. But now there's an additional factor. The US yields are holding up. In this sort of environment, how do you see flows move, for emerging markets like in India as well as China?
The lifeblood, so leave China aside. If you look at all of the emerging markets, the emerging market ex-China, and you draw a chart, their growth rate, emerging market ex-China's growth rate and global trade, there is no daylight between the two of them. You do that for India, there is no daylight between the two of them. So if global trade is under attack and global trade actually stumbles in the next 2, 3, 4 months before, let's say, we have a negotiated compromise, then I do not think that emerging markets growth gets spared. If emerging market growth doesn't get spared, as you well know, there is no flow to emerging markets. Now, the question is where there'll be outflows. Well, I don't see there's much room for outflows because there weren't any flows over the last 3-4 years in the emerging markets for that to flow out. So I think that is a saving grace if you look at it that way.
All right.
Jahangir, just 30 seconds.
Sure.
You think they will try something new? Because, this experiment has failed. You think there will be another attempt some other way? I'm talking about...
Look, I mean, it is... Yes, I think having these kinds of tariffs on China and US on China on US and US and China is untenable, right? So clearly there has to be a solution, a resolution of this. We have no real sense of what the resolution is going to be and how long it will take. But you can't have a global trade system where the two largest players are putting triple-digit tariffs on each other. That's just not a tenable situation.
And if you think that they really wanted lower dollar and lower yields, they've not got lower yields. Temporarily, they got under 4%, but they've certainly got dollar lower. But of course, I mean, the collateral damage is confidence and everything else, right?
Yes. Yes.
So I mean, it's.
So I don't think it's.
Yeah, go on.
Yeah, look, I mean, these are thoughts that have been put out by the White House and people around the White House, in the White House. I don't think there's a very well thought out argument. I know most of my clients ask me about the consistency in the policy of this administration. I don't think you should look for consistency in these policies.
Okay.
I think what you should look for is the policy and try to figure out what the impact is going to be.
Don't try and form a coherent explanation, right, to what is going on, because maybe there isn't one, as you say. Jahangir, great conversation. Thank you very much as always, and I look forward to our next one. And do join us more frequently. We need you with all that is happening. So thank you.